Good afternoon. My name is Mark Levine. I'm the Executive Director of the Municipal Electric and Gas Alliance. And I want to welcome you to an engaging lunch and learn. This is your opportunity to dive into everything you need to know about natural gas and how the MEGA and NRG partnership can benefit your municipality or school. You will have a chance to connect with our expert in natural gas and discuss how current events may be impacting your gas budgets. This presentation open forum will allow you to learn from the experts, but also to convene with organizations just like yours on this important topic. At this time, I would like to introduce Mark Taylor, the chairman of the board of directors for the Municipal Electric and Gas Alliance. Mark.
Thank you, Mark. Good afternoon, everyone. I'm Mark Taylor, and I chair the board of directors for the Municipal Electric and Gas Alliance. MEGA is a not-for-profit municipal development corporation. We serve 237 municipalities across upstate New York. So we're a major player in the gas and electricity business in upstate New York. We were created about 27 years ago as a local development corporation between Tompkins County and Tioga County. And we continue to be governed by county representatives and in our board of directors and on our corporate board. Our public procurement process includes a piggybacking provision so that once we have an approved procurement in place, other municipalities, school districts, hospitals, not-for-profits can piggyback on that contract to obtain natural gas and electricity. We want to welcome you here to our first Lunch and Learn luncheon from 2025 to learn about the natural gas market in New York State. MEGA's bid for natural gas went to NRG, and so they're here today to tell you a little bit about the current situation with natural gas. It's my honor to introduce our partner, Dylan Haas of NRG, to talk about natural gas and the natural gas market. Dylan?
Thank you very much, Mark. Happy to be here to help speak about the natural gas markets to you all. As I mentioned, my name is Dylan Haas. I work as the account executive at NRG, helping the MEGA aggregation kind of group to help provide natural gas supply to their members and help try to get the proper product in their hands. And this is also just one thing that we like to do, which is educating our customer base. Just because an educated customer is a good customer helps them make the right decisions. And in this case, we're looking for always the best pricing we can offer. But when prices are not necessarily doing the best things possible and staying low, we always want to know exactly why. How can we prepare in these kind of market events to make sure that when we are going to buy, things are going to be taken care of properly so that your constituents are taken care of? So I want to share screen. I also, while I'm doing that, I'm going to say that the way we typically do these kinds of things is going to be it can be super formal. I don't think this has to be super formal. I would actually prefer if you guys ask questions halfway through, feel free to put them into the chat. I'll be watching that. Or you could try to, I'm not sure if there's a raise hand function or something that you can do to try to make sure that you guys can ask questions halfway through. I'm more than happy to discuss as much as I can about these markets. All right, I am screen sharing, it says, and apologies if I'm not looking directly at camera. I got a few different screens going here at the same time. So can everybody see the screen that says just Natural Gas 101?
Yes.
Wonderful. Alrighty, I'm going to keep it outside of presentation mode so I could skip around if need be. I think that also will help in case there are questions, because that means we could jump back and forth if that would assist. But as I mentioned, please feel free to jump in if you have any questions. I'll try to provide some spaces between slides to make sure that that can happen. Alrighty, I'll just start clicking through. Why don't we? We do have a little safe harbor notice here just for our legal necessities. But we do want to start with the actual presentation, talking about the most basic parts about natural gas. We're going to talk high level about how the natural gas market works. And if we think about natural gas just as a subject, most people think about it just as a price, and then all of a sudden my buildings are heated, my stoves are working, etc. But there's a whole process to get natural gas because it is a physical commodity, not just a price. So when we talk about commodities, it is a physical item, meaning that there has to be economics that back the pricing that gets there. So one of the laws of economics, of course, is going to be the law of supply. And when we talk about natural gas, there's a few ways we get it into the United States, and more specifically into New York State. I'll talk about these first 1 and 2 pieces because that's really how we get it out of the ground. And then that third item on the right-hand side is going to be how do we also get it within this region? And then more importantly, how does that start to impact the rest of the markets? But we'll start with 1 and 2 first. The first natural gas, let's say, well that was developed was what we call traditional natural gas well. It is a conventional well where we just dig straight down. We like to think of like a jelly donut. You dig straight down, you hit a pocket of jelly, and it just starts spurting natural gas. This is the quickest way for us to get natural gas out of the ground, but is more commonly found near the oil fields down in Texas, Louisiana, and those kinds of territories. More recently, in the last decade and a half, there was this new kind of play that's called a shale play. This is where we use unconventional wells to do horizontal drilling that does hydraulic fracturing, then using water and hydraulic fluids to be able to crack and fracture the rock, allowing for natural gas to flow out. This was something that was more or less developed in 2008 and became popularized by 2012, allowing for prices to fall drastically from those 2012 prices and allowed for natural gas to become a much larger part of our energy industry, but also just for electricity's sake, since natural gas is also a large part of the generation stack for electricity. This also helped kind of develop a new market for energy and natural gas itself. These are the 2 ways we get natural gas out of the ground, historically speaking. There's not really any other ways to do it, but there is a third way we get supply into the United States. So we're not just talking how to pull it out of the ground, but how does the United States receive it? LNG, or liquefied natural gas, is a large topic that is growing in the United States, and this is a condensed version of natural gas that is so cold it has become liquefied, and it's under huge amounts of pressure and is done so artificially by folks who are transporting it internationally, typically speaking. This means with international transportation of natural gas and this energy fluid, basically, that you're going to end up seeing larger impacts from the recent topics of, for example, the Canadian tariffs. Although they typically pipe that in directly speaking, LNG is more or less the marker I use whenever I'm talking about international pricing, because LNG is the most cost-efficient way to transport natural gas internationally. This has become a larger topic in the United States as well. I'm sure many of you have heard at the federal level the current administration talking about America becoming its own energy independent kind of country, working to help supply the EU for natural gas especially. This has become a large topic after the Ukraine war because Russia, historically speaking, has been the international provider for European and Asian countries. And after the Ukraine war has begun, they've kind of been, let's say, stopped from providing natural gas to our allies, frankly. And that has allowed the United States to overcome the Russian natural gas exports. So although it is a supply, it is also now becoming a larger demand topic as well. These 3 things play a large part in pricing, and we'll talk more about how these function. But before I move on, are there any questions that anybody would like to ask?
There's a couple of ways you can ask a question. This is Mark Levine, the Mega Executive Director. You can raise your hand. You can type into the chat, or you can just unmute yourself and ask a question. Thank you.
Well, wonderful. No questions, so we'll keep moving on. I have one more slide talking about where the gas is coming from, and I think this is important more or less because mega participants are all New York based. And when we talk about location, natural gas production is critical to understand where is it coming from. Now, I talked about the Texas-based more traditional wells and more recently the Marcellus Shale / fracking revolution that has more come out of the Appalachian Basin region. So you can see that on the left-hand side in this kind of picture right here, showing some of the lower 48 states shale plays. This is important because one thing you'll see is that there's a large supply of it coming straight out of the territory, straight to the south of New York. And although there is a overlap in the New York State, one thing to keep in note is that New York does not permit for natural gas fracking. So we're not going to actually see supply bonuses in this territory as a result. Proximity has definitely helped alleviate some of the price costs that had been assumed over the last 2 decades, but it still is a rather congested territory as there aren't many pipelines going into the New York State. You can see on the right-hand side that there is a large set of infrastructure, all based mostly around the mid-continent, connecting some of these different shale plays down to the south, some of those LNG terminals down that way, but more or less stays out of the New England and New York regions. This becomes a larger topic when we talk about transportation, and when we think about the fact that New York is not producing itself, not having large amounts of transportation into the region is going to be a significant cost factor going into this territory. This isn't necessarily new, but when I think about a pipeline, it's not just one unidirectional. It actually has the ability to pull natural gas out of your region as well, because most of these pipelines are bidirectional. Now, historically speaking, New York and New England tend to be some of the most expensive regions to buy natural gas and electricity because of the lack of pipeline infrastructure. But one thing has even enhanced some of these costs going further down the line because these pipelines are growing. When we think about that LNG topic, most of those facilities, of course, because they're shipping it internationally, have to be coastal based. A lot of these pipelines that go into the New York region, one isn't shown on this line. It's called the Transco pipeline, but it kind of follows the coast and it goes right up into New York State. That pipeline follows a lot of the LNG terminals, and that has forced New York to basically play tug of war against these locations that basically represent international interests. So a lot of changes of how international pricing has been moving in the last 5-6 years is starting to play not just on the international stage, but is starting to impact domestic pricing and more specifically New York State and New England locational pricing. I want to talk a little bit further on the topic of transportation. So I thought this would be a really good chart to kind of demonstrate the overall process, because just drilling into the ground and hitting a pocket of natural gas isn't enough for you to be able to burn it at your homes. It wouldn't be safe, for example. So we have to follow a bunch of different steps to be able to get it to your locations. On the left-hand side, you see this general trend for where we have producing wells. You push it into an interstate pipeline, it's going to be compressed and put at a certain pressure that then allows for it to travel down these pipelines across these different pieces. The first step after pulling it out of the ground is actually to process it. These tend to be close to the processing, from the producing wells. And what these do, well, they'll clean it out, first of all. You'll get rid of the dirt, water, and hydraulic fracking fluid. And then what you'll also see is that they'll separate the different types of fuels out of it. The term natural gas itself, for example, is just one large term saying how much it's a fuel that contains many different types of volatile compounds. The primary one is typically methane, but there is butane, ethane, propane, all sitting within this natural gas name. So processing will help specify which ones are going to be pushed onto the pipeline so we don't end up with explosions further down. and then also so that we could start the transportation pipeline process, on the pipeline process. The next step we'll see is that they'll go to storage, so we could use them for the winter times. And then after they're used for storage or they're being pulled out for you to use at your facilities, they're going to be pushed across these interstate pipelines to your local city gates. These are run by the city/utility. They measure the amount of natural gas flowing in to the total local area. They're going to be decompressed, so they'll be at a lower PSI, and then they'll be pushed to the larger volume user customers, and then to the residential customers and commercial customers. It's not just a straight line, of course. All these different things kind of loop back on each other. There's a lot of circles for redundancy to help make sure that there are different ways in case there are incidents across these pipelines to make sure that we're protecting the total supply of natural gas to these different territories. Overall, this is a pretty simplistic view, but demonstrates the complexity that can go into making sure that you're receiving natural gas and able to heat your homes, businesses, and facilities throughout the winter times when it gets super cold, or even produce electricity during the summer times when you need AC. Any questions so far? I don't see anything in the chat. I double check. Nope, all good. I'll give one quick second so I can take a break. But anybody else have any questions while I take a drink? Keep moving along. I mentioned storage in that last slide. It kind of sits between the processing plants and delivery, right? The storage slide is critical to understanding where pricing is going to be. This is the buffer that allows for the United States to have enough gas stored for the winter times. Typically speaking, we don't have enough production every single day to make sure that winter is always provided for. So when we look at the overall production number, it grows at a pretty steady rate, except for the fact that during the winter times, we're using so much of it, we're actually using more than what is produced on that day. So we see two different seasons, more or less. We see a declining season where it goes from pretty much just the winter months for about 6 months. And then we see a season where the natural gas storage grows. We call those two seasons the withdrawal season and the injection season. The terms when we get to the switches between March to May and October to November, typically speaking, is what we call the shoulder months. It's when usage is lower because it's not too hot that we're needing it for generation, and it's not too cold that we're using it for heating, at least greater than the production numbers typically would be. This is very important to understand, and I can't overstate this. Natural gas, in fact, will trade very heavily depending on what natural gas storage is reported to be. In fact, every single week, every Thursday at 10:30 Eastern, we get a EIA, an Energy Information Administration weekly storage report. And that storage report can drastically move the price of of natural gas every single Thursday. And honestly, Thursdays tend to be not necessarily the best of trading days just because of that. This is because natural gas storage numbers dictate how much elasticity the supply side of the equation has to be able to protect natural gas pricing during the winter times especially. So recently speaking, if we look at this graph, we could look at this black line, and this will show the year-to-date storage numbers. And this was updated a couple of weeks ago. But what we'll see is that we went from a surplus during January and throughout 2024 to a deficit below that pink line. The pink line is showing the average, the black line showing the year-to-date. So now that we've fallen below this historical average, we're now putting ourselves into a state where we're a little bit below the typical supply amount. This is leading to a drastic increase of prices that we hadn't seen previously. It wasn't expected. This is a large deviation. And one thing to note is that this is just the supply side. Demand is continuing to increase from those things like LNG. we're seeing demand increases from larger amounts of production domestically and a higher reliance on generation facilities utilizing it for power generation. So all those three things, paired with the change of supply, are starting to flip the market from where we had been the last couple of years. The other thing to think about for storage numbers is that this is greatly impacted by weather. Weather is a huge demand center because everybody in New York State, for example, is going to be using natural gas to heat their homes. So when it gets to be a very cold, wet winter, like it had been this year, or at least colder than expected, we could see large deviations in storage, and that typically is what is reflecting in price more so than just cold weather. I'll move to the next slide. We see that we have a more topic that starts hitting on the economics portion. Price, of course, is the dissection of the lines between supply and demand. But when we look at price specifically for natural gas, there is this other concept we need to think about, which is the difference of prices between location. So when we think about the overall commodity, we talk about price. And when we say fixed all in, it's actually these two separate portions of gas pricing. The commodity is the national marker for natural gas. This is New York Mercantile Exchange, Henry Hub natural gas pricing. Henry Hub is a location in Arath, Louisiana, where natural gas as a molecule is being traded back and forth, which means you could physically pick up natural gas at Arath, Louisiana. Thing is, you guys aren't in Louisiana, you're in New York, right? So how do we get natural gas from Arath, Louisiana up to New York State? Well, we transport it on these pipelines. And when we're transporting on these pipelines, the differences between those two prices is what we call basis. Your basis price is your local price, and that is going to be the difference between the national total commodity and what you can get for it locally. So when we talk about it, the simplest way to think about it is how do we transport it and what is the cost associated to getting natural gas actually to your facility and the difference and adding that on top of the actual wholesale commodity. The other allegory I use for this is that if you're using something like Best Buy to buy a computer or something like that, the computer itself might cost you $300 to $400, and that's the commodity price. That is the actual physical computer. The basis price is the cost of having Best Buy use UPS to deliver the computer to your home. That's the difference. The total price for each of these items is fluctuated by these different items on the right-hand side. We have a whole bunch of things that play into natural gas pricing, both on the commodity side and on the basis side. Each of them will have their own specific cost impacts for basis and commodity locally and nationally. So both of these can kind of compound one on top of each other. The major ones we've already talked about, of course, has been supply and demand as driven by weather. Those both play into the weekly storage report. And then, of course, another thing we need to start thinking about, especially more recently, has been economic trends. One thing we've seen a lot of has been the cost of tariffs. There's been a large conversation about that piece. That also kind of fits underneath the concept of policy changes, of course. Although we see items at the federal level, there's also local things we need to consider, like PUC or public utility commission can have some impacts at the state level or even local level. But when we look at the overall impact of each of these, they can have both impacts on NYMEX and on basis. Locally, of course, we already talked about pipelines. Infrastructure plays a huge bit of this. This can also be considered partly just overall demand pieces too. We talk infrastructure, we oftentimes think just supply, about the pipelines being pushed from Pennsylvania to deliver natural gas up into your territory. But typically speaking, we could also think about things like data centers, which are starting to use more and more natural gas for electricity generation, necessitating higher demands for that infrastructure and causing more of a competition for the supply that you typically had received before that. When we talk about natural gas, there's also some more things we need to consider. As a commodity portion, we also have to think about how does it trade? Because it's not just this effervescent, I give you a single molecule. When we talk about natural gas, there's a lot more complexity to the way we structure pricing. In fact, we have to come up with a more or less standard way, and the easiest way to think about it is this simple contract. And this is the basis, the building block for how you receive your pricing. A gas contract that NRG trades is going to be based off of 10,000 decatherms delivered each and every month, but each and every month will trade separately. So my price for May, for example, will have a certain supply and demand, a certain weather forecast, a certain amount of forecasted weather, and I'll be trading 10,000 decatherms based on that for that single month. But my price in May is going to differ heavily from what I'm using in January, because January will have its own supply and demand, have its own weather forecast, its own weekly expected storage, et cetera, et cetera, et cetera. That means every single month trades its own individual price for its specific amount of volume. This completely confuses a lot of folks, so don't be concerned if you're the only one. But this means that when we're looking at delivering prices, we need to be able to deliver different amounts of natural gas for different months to your facilities, which causes us to have to weighted average your costs against these markets. This can be very complex to get into, so I'm going to kind of keep it at that high level and just say that each and every month has its own price. We're delivering based off of what the market is dictating for that specific month. I know we're running a little bit shorter on time, so I'm going to keep going just to keep demonstrating this real quick, and then we'll see if we have some more time for questions afterwards. This next slide is talking more or less about settle prices. So I said each month has its own trading price. Well, this demonstrates how each month has settled the last trade that was made for that month. And so we're showing how this changes month to month to month, going all the way back to 2008. I mentioned that we had that shale revolution for Marcellus shale and fracking. It saw a huge drop off on pricing. We got into a situation where prices kept going lower and lower and lower until 2020. We saw a large increase when the United States started playing into the international markets for the LNG exportation. We got super warm winters, 2 in a row, and allowed for prices to fall off a cliff, get us back into a low price environment. And then all of a sudden it got cold again and prices have increased. This demonstrates the volatility of these markets and why fixed prices can be useful for entities who have a pretty specific budget that they need to make sure they're monitoring, because these volatile times can lead to very varied increases of pricing. If we look at, for example, January 2025, where we had a price of 351.4 settle, this is very different from where we had been just a few months prior, and we saw prices down at $1.61. 100% increase of prices within a year. This is why fixed price has been helpful for customers, because this is going to be helping keep their budgets a little bit more flat and helping them at least be able to plan on it a little bit better. I have one more slide talking about basis. I think this is helpful to just have a background. This will be just something that you all can reference if you need to remember what basis is. But again, just simply put, it is the transportation of natural gas. I also wanted to show one more slide, just helping talk on the LNG front, just because this kind of talks more into the 201 kind of level stuff, or where we're starting to see a larger demand internationally. When we talk about international demand in LNG, we often think we're able to complain about domestic pricing, but looking at international prices that are about 3 times to 4 times what domestic prices are, there's a huge difference between international prices that Europe, the UK, and Asia are paying to what the United States Henry Hub is. So that difference allows for producers in the region, which NRG is not one of, to be able to ship this natural gas out internationally and make a huge profit on that. This is where the United States is tending to move to in the next few, like 5 to 6 years here. and is one of the driving cost factors that has been playing in the market and the continuing rising costs. Larger developments in LNG have started moving us towards a rising market from where we had been historically speaking. But as of right now, we still do see some opportunity with doing longer term pricing. One thing I want to note right here is kind of on that topic. I know it's hard to see, it's a little bit dirty and messy right here. But one thing you can see is that although prices start to move up into the situation, this dotted line is actually your forecast. And so that forecast is actually showing prices are moving down if you do longer term contracts. I know a lot of entities are kind of forced to do 12-month, and that might be part of their policy. But if you have the opportunity to look at longer term contracts, Mega has the NRG contract through October of 2029, which is frankly as long as the what we call backwardated market has opportunity for. So we're always looking for where opportunity lies, and in this case, it is in a falling market with longer term contracts. Unfortunately, it is a higher market than we had been historically speaking, but because of all those fundamentals that we've covered so far, this is why we've seen an increase of prices overall. The question now is, how do we decide to manage your budgets, and how can we work with you to make sure that you are prepared for this always changing market? I see we're a little bit over, but I do want to cut it there. I do have time for some questions. I set aside an extra 30 minutes here to discuss if anybody has any extra questions to kind of see if I can help provide some more education for this group. I see one question just popped up where it's saying, what time of year is the best time to sign a fixed price contract? That's a good question. It's one I get all the time. Frankly, some people claim that there's a reason to try to purchase in the shoulder months, which, as a reminder, if we look back at this just yearly thing, happens to be around the turning points between winter and summer and winter. Those tend to be the shoulder months. Some people like to purchase during those times because that's when they have most recently gone through the most recent market and have what they expect to be a good time to purchase because the markets get a bit less volatile. I tend to agree with the overall concept that it's less volatile, but it's hard to say that it's going to be the best time to sign. Signing a fixed contract always has innate concerns in the sense that you're going to be purchasing 100% of your volume. And so while that is a great way to make sure that you have budget certainty, saying it's going to be the best time is not necessarily that. One thing we can do, and I'm not sure if you guys know this on the call, and Mark and I were talking about this right beforehand, is that there is this other topic called, and it's a bit more complex of a product, but it's a combined type product where what we'll do is we'll make sure that we have the transportation of natural gas secured to your facility. And we have the other opportunity, which is to float the commodity. This means that the portion of your bill that is transportation is fixed, while the delivery of natural gas is subject to change to whatever the markets decide it's going to be. This means you're taking less of a stake in the market in the sense that you're not saying, hey, I believe the market's too high or the market's too low, and you're not making a claim that you're going to beat the market. But that would then allow you to make a decision down the line. If you say, hey, we do need a fixed product, we could take a hedge there. Or what you can do is make sure that you have at least your transportation set, giving you more flexibility with your month-to-month pricing. Overall, if I was to try to condense that into a simple one-sentence answer, the best time to buy is unknown. But there are ways you can mitigate risk by choosing specific products that best help your county, your municipality, or your school district. And I can help have that more specific conversation with you if you'd like to.
Segueing off of that, Dylan, it's this Mark Levine again. Can you talk briefly about the difference between using NRG or using NRG through Mega versus going or using natural gas directly from the utility?
Sure. Yeah, that's a great question. This one pops up often. So I'll start with explaining what Mega and NRG are. And as Mark had mentioned, Mega is a nonprofit organization looking to help make sure that you guys can get that piggyback contract with us. And the reason to go with NRG is because we differ from the utility in a couple of ways. The utility is going to give you that natural gas price every single month at whatever market is, but they're going to have to deliver based off of what that price is going to be at that very moment. There's no way to plan whatsoever for that. That means when you're with the utility, you are a price taker 100%. You can't budget it. It's just going to be, I need natural gas at my facility. It needs to be heated. Got to deal with that. Got to pay that bill. It is what it is. With NRG, you have the ability to plan for those bills with a fixed contract, or we can help prepare you with a specific index type contract if that's what you'd like to do. So there are different ways if you don't want to take a stake, but do want to have a sort of plan. And the other reason to go and take a look at this Mega/NRG partnership is because NRG differs from the utility in the sense that we are a international company, not just national, able to leverage assets from across the country, across the countries, frankly, to help make sure that we're getting the best prices to you. We talked about pricing, and when we look at pricing, we said that there's the commodity portion and the basis portion. Commodity is commodity is commodity. There is basically not a discrepancy between which supplier you go with, and it'll always be pretty much the same price anywhere you go. Basis is where utilities and different suppliers get their competitive advantage. And by leveraging our assets outside of New York State, NRG is leveraging production lines that come from all across the United States to get you the best pricing for natural gas into your territories. That's why NRG is the best, and that's why we were selected to go with Mega going through October of 2029, and why we can provide pricing up through then. But yeah, that's the difference between NRG and the utilities. I see any other questions on that, Mark, before I move on? All right.
Oh, sorry about that. I got myself on mute again. So on that, so tariffs, the transportation costs are the basis, right? So where are we getting the natural gas from? And are you worried? Should we be worried about tariffs when it comes to natural gas?
Yes, that's a good question. The tariff question is a big one. This is developing day by day, so it's hard to say exactly how this is going to play in. I will note that that means that the folks who are trading this day by day and dealing with these markets day by day have already factored that in, as this is something they've already known is going to be playing into it. But they've also factored in the fact that it could go lower. So you deciding to take a play based off of that could dignify and say that, hey, although the market could go higher, it could go lower too. It's hard to say precisely. The tariff conversation is massive. It is going to be a 10% cost potential coming from Canadian imports, but the total impact is going to be not a 10% increase on your total bill. It's just going to be a 10% impact probably on the Henry Hub on the national scale, not necessarily on the domestic, because it's not just impacting New York State. Because natural gas itself, where's it going with this? When it's coming from Canada is not 100% of the natural gas we receive. The majority of natural gas in New York State does come from American sources. So as long as we're able to maintain the capacity, the ability to deliver natural gas into the New York State region at the quantity necessitated, we shouldn't see too much of a cost impact, at least in your territory. That's not to say we won't see some cost impact, but it could be a volatile situation depending on how significant these tariffs decide to play into. It also depends on your region. If you're right against the border of Canada and you rely heavily on natural gas imports from Canadian sources, that can be a larger impact than if you're closer to the Pennsylvania border or closer to one of our own interstate pipelines that is more constituent to America. I saw a question that kind of goes and piggybacks off of that too, that states with the LNG market growing, data center growth, and then I'll throw in there the concerns with tariffs playing into that. There is concern for growing market price, but we do see a backwardated market, meaning prices after we get through this front year, as in the rest of 2025 going through winter of 2026, we see a decreasing of price. And you could see that on this forecast where it kind of starts to dip over time. Why is that the case when we're seeing all these growth patterns and we still see a backwardated market? In my opinion, that's actually showing opportunity. I do think that those are all bullish factors that aren't necessarily going to be going away anytime soon. Unless demand increases, with all these demand center increases and supply is not necessarily showing very much opportunity of growth, especially within New York State, this gives us a better reason to take out these longer term contracts because this is a situation that doesn't seem to make sense with some of these fundamentals. I'm not saying necessarily that that's my advice. It's just showing itself as the opportunity to take advantage of the lower prices than what we see presently speaking. The other way that people do read this, I will play devil's advocate with myself, is that saying, hey, maybe these current term prices are overstated. Maybe we expect them to dip. But frankly speaking, the way we've seen markets settle for the last couple of months has been very high. And the reason why has been uncertainty in the market from these tariffs, from data center growth that has been extremely quick. But most importantly, from that storage change. When we have low storage numbers this winter that put us into a deficit from where we were historically, it's not putting us necessarily in a bad spot for just this instance. This is a concern because this puts us in a bad spot for next winter as well. Unless our supply increases significantly and our summer is extremely cool, then it's unlikely for us to get to back to a large enough surplus for us to beat out the demand potential. And that's why prices are showing higher for the next year and then decreasing onwards. Storage is the primary fundamental that I'm paying attention to in this case. I see Dan Cook also put a question in asking, do Mega members receive their NRG billing on their utility invoice, or are they billed separate on a separate NRG invoice? Is this utility dependent? And yes, it is utility dependent. And it is also going to be dependent on what kind of billing you do. There are certain utilities where you can do consolidated billing, where the utility is going to have a single bill that'll be sent out that'll include NRG supply charges. In the most case for natural gas, though, we do tend to see that almost every utility will be doing separate billing from NRG. And that's because if we think about the deliver side of things, there still is two different types of processes of getting natural gas to your facility. When we're talking about natural gas supply and delivery, we're talking as NRG about transportation. And my equivalent to that for power, which might be easier to visualize, is we are the pylons moving power, except in this case, natural gas, across large distances to make sure that it's brought to your local facilities, who can then distribute it further out. The utility is still going to give you a separate invoice for the distribution, where they take it from the pylons, they put it through a compressor station or a city gate / substation, and they'll put it into a lower pressure that can then be delivered to your local through your local pipelines. So when you go with NRG / Mega, you'll receive one bill, typically speaking, with your total supply charges along with your transportation charges, and then you'll get another bill coming from the utility with now no longer including supply. It's just going to be for a smaller portion for distribution. I hope I answered that. I see another question just came through. I see Paul has a question asking, for schools that do not operate in the summer, if prices tend to rise in the winter, could you recommend a fixed, variable, or mixed price product? So that's a great question. Different products have different risk appetites, and different terms, of course, have different pricing. So if pricing, for example, in winter tends to be higher, and that's only when you're operating, let's simplify and say you don't have any load during the summer times, then you'll see a higher weighted average to the winter months, which has higher volume and now higher prices. So overall, your contract is going to go show higher than the average market, but you also don't have any costs during the summertime in perspective. So What products do I recommend given that information? It's hard to say because it still depends on each school district. How do they want to manage their specific budgets? In general, I've seen fixed prices be helpful because it still gives them the same rate month by month by month, even if their price is going to be higher, their total cost is going to be higher during the winter, just because they're actually using more natural gas during that time period. However, if you like the idea of having a index type product and you want to see, or even a combined type product with part of it floating, then what that would allow for you to do is have a lower rate during the summertime. And for the small load that you do have during that time, have an extremely low bill. But during the winter times, you'd have an even higher bill reflecting the shift of the market along with the higher usage. So your cost won't be averaged out as much as if you had a fixed price. That being said, different school districts that I've worked with throughout the states, not just in New York, have done both products and have seen success with both. It just comes down to what your risk appetite is, what your budget is, how much do you have to be able to protect against huge volatile swings. I'm more than happy to have that conversation with any specific school district. If you want to talk about what your budget looks like, how you want to manage your risk, it can be very specific for each and individual school district.
Are there any other questions for Dylan? Dylan, we work with you on a regular basis. We're talking, emailing, and we have meetings every week. We appreciate everything that you do for our members across the state of New York, and we thank you for bringing your expertise to us here today to help us inform our members about the energy market so that we can all make better informed decisions about our energy use and supply and purchases. Mark Taylor, I want to turn to you for one last word.
Right. Thank you, Mark. Yeah, again, thanks very much to Dylan. It's very informative. I think this is going to be an area where we see a lot of change and a lot of uncertainty going forward. But Mega's here to help smooth out those changes and provide the best pricing we can. I also want to point out that one of the advantages of being a member of the Mega community is also getting this kind of advice and support in addition to just your electricity and gas supply. So we're here as a nonprofit for our members and to provide this kind of support to them.
Thank you. And Dylan, I guess I'll give you the last word. Wrap it up, please. Sorry, I'm mute.
All right, it was on the computer. It was fun to me to be able to explain this stuff. I love working with customers to explain how these complex markets work. Of course, there's a lot to this, and I know some of this still seems complex and is hard to understand. I want to be here to make sure that I can help provide any information I can to you guys. An educated customer is a good customer, and Mega and NRG have partnered together to try to make sure that everybody here can make educated energy buying decisions for both natural gas and electricity. And so what I would like to do is make sure that I extend the offer out for everybody. If you guys have any further questions, if you didn't want to ask questions here, if you want to ask questions on email, send me a call or give me a text. I don't care. My information is made pretty publicly available, but I want anybody to feel comfortable giving a ring and giving me an email just to ask some questions about how does this work. Happy to talk about this with you all, and also help make sure that anybody else at your organization feels comfortable with this buying decision, because this doesn't just have to be just a you thing, passing this information along. We're here as partners to help make sure that you guys are ready in these volatile and ever-changing markets. Happy to be here, and I'll wrap it up with that, I guess.
Thank you, Dylan. And thank you all for joining us. And thank you for being part of the Mega family. We appreciate you being a part of this. And we are honored to be able to help serve you and your energy needs. Thank you.